It happened again, but this time it was bigger, faster, and more violent than most traders have seen in years. Silver, one of the world's oldest stores of value, didn't just move, it whipsawed. In the span of hours, the price plunged from $105 down to $92, then screamed back up above $107, a move big enough to wipe out entire trading books, blow out leveraged positions, and send shockwaves through both Wall Street and Main Street investors. Futures volume hit records. Exchanges reported more activity than during the 2011 silver squeeze. Brokers scrambled, and by the end of the day, traders were left asking, what just happened? All right, let's break this down step by step. Yesterday, in a trading session that will be studied for months, silver futures on COMEX opened around $105 per ounce. For context, that's near multi-year highs and well above long-term averages. But then something extraordinary unfolded. Within the first 2 hours of trading, silver plunged from $105 to $92. That's a drop of nearly 13% in an asset that usually moves in fractions of a percent per session. This wasn't a slow bleed. Price bars were 3–4% moves on single trades. Then, just as rapidly, prices reversed direction, climbing from $92 all the way back to over $107, a rebound of more than $15 in a few hours. In the course of this volatility, futures volumes spiked to all-time highs, eclipsing even the famously chaotic days of early 2021. Newswires reported record open interest, meaning more contracts were outstanding than ever before. To mainstream observers, this looked like chaos, but to analysts, it was structure, and it tells a deeper story about the state of global markets, leverage, and the fundamental disconnect between paper and physical markets. Let's unpack what's going on under the surface. Futures markets. Silver's price action is primarily governed by futures contracts, standardized agreements to buy or sell at a specified price on a set future date. Most traders don't take delivery, they're playing price moves. On this particular day, leverage positions were stretched to extremes. Hedge funds and speculators had record net long exposure. When prices dropped, margin calls hit. Brokers demanded more collateral. Forced liquidation of long positions intensified selling pressure, driving prices lower in a cascading effect. This is a classic stop-run dynamic. Once key technical levels are broken, automated orders accelerate the move. Physical supply. But here's where it gets interesting. While paper prices plunged and rebounded, physical silver markets told a different story. Dealers reported tightening inventory. Premiums for physical delivery, particularly in bullion coins and bars, widened. Some refineries announced delays due to high demand. So while futures scrambled, the physical supply chain remained strained. Another key factor reinforcing the rebound. Technical levels. Key technical levels were in play. Support near $95 short-term trend line gave way briefly. Next major support near $90 triggered stops. Once downside momentum exhausted, buying interest emerged and reclaimed $100, then $105, pushing toward $110. Institutional positioning data showed huge clustering of orders around these price bands, which created both magnets and shock points for volatility. Silver doesn't exist in a vacuum. Its behavior reflects much broader forces. Federal Reserve policy. The Federal Reserve's stance on interest rates has huge implications for precious metals. Higher rates generally strengthen the US dollar, pressuring silver and gold. Lower rates or expectations of rate cuts weaken the dollar and can benefit metals. In recent weeks, markets began pricing in a pivot from the Fed, or at least signs that inflation is easing. That change in expectations is part of what has silver trading at elevated nominal prices. Inflation and currency instability. Globally, inflation remains a concern. Central banks in Europe and Asia are still dealing with price pressures. Emerging markets are experiencing currency volatility, pushing local investors into hard assets like silver. Silver often acts as both an inflation hedge and a currency hedge, so macroeconomic stress plays directly into demand. Geopolitics and supply chains. Ongoing geopolitical tensions, from trade disputes to mining disruptions, have also constrained supply. Top silver-producing regions have reported strikes and logistical bottlenecks. Energy price volatility impacts mining costs and output. These macro forces help explain why investors are positioning for higher prices even as short-term paper markets swing wildly. This is a crucial point that many commentators miss. Paper markets, futures, ETFs, options are where most trading volume occurs. Prices in these markets adjust instantly to news, sentiment, and technical triggers, but this price isn't always reflective of actual metal changing hands. Physical markets. Physical markets, coins, bars, allocated bullion are driven by supply, delivery timelines, mint capacity, and shipping logistics. On the day of the move, dealers reported physical premiums widening sharply. Many online inventories showed out of stock on key bullion products. Delivery bottlenecks meant buyers were paying more for physical silver, even while the paper price dipped. That divergence matters because when physical demand outstrips available supply, it often indicates real investor conviction, not just speculative positioning. To better understand this moment, we can look at past episodes. 2011, silver squeezed back. In 2011, silver prices surged from around $30 to over $48 in dramatic fashion. That move was supported by physical demand and retail investor fervor. Then prices collapsed back under $30. What made that event notable was the disconnect between physical shortages and paper selling, a theme we see echoes of today. 2020 COVID crash and recovery. During the early COVID market crash in March 2020, silver fell sharply from around $17 to $11 as markets panicked. Then it rebounded sharply as stimulus, zero rates, and hedge fund positioning drove massive re-risking. The current volatility carries similar hallmarks: forced selling, technical break levels, and the rebound fueled by aggressive dip buyers. But this time, we're at much higher nominal prices and a much more leveraged market structure. Let's break down two divergent pathways the market could follow from here. Bearish scenario. Prices could fall if Fed tightens further. If inflation flares again and the Fed signals more hikes, the dollar could strengthen, pressuring silver. Liquidation continues. If leverage positions remain heavy and margin calls intensify, forced selling could overwhelm demand, pushing prices lower. Economic slowdown. A global slowdown could sap investment demand as risk assets reprice and investors seek liquidity. Under this scenario, we could see silver retest lower support levels, $90, $85, or even lower, particularly if technical momentum turns decisively negative. Bullish scenario. Major rally triggered by physical demand surges. If premiums persist and inventories shrink further, physical tightness could break price ceilings. Monetary policy shifts. If central banks pivot to looser policy or real yields drop, safe haven demand could surge. Geopolitical stress, heightened currency instability or crises could push investors into hard assets as hedges, boosting silver. Under this pathway, we could see silver challenge $120, $130, and beyond, especially if market positioning flips from net short to aggressive net long. Here are the important levels and metrics every serious observer should monitor. Price levels: support $90, $85, resistance $110, $115, $120. Futures open interest rising OI during price increases suggests strong participation. Falling OI on declines indicates capitulation. Physical premiums: look at dealer spreads and delivery backlogs. Fed policy signals: CPI data, Fed minutes, rate outlook. Dollar index, DXY, correlation, often inverse to precious metals. These data points will help frame where the next leg up or down begins. Before we close, here are your three most important takeaways. This move wasn't random, it was structural. Forced liquidations and institutional positioning drove the initial drop. Aggressive buying and physical demand fueled the rebound. There is a real divergence between paper and physical markets. Price in futures doesn't always reflect the state of actual supply and investor demand for physical metal. Macro forces, Fed policy, inflation, currency dynamics are central. Silver is not trading in isolation. It's a barometer of broader global economic stress and monetary strategy. So what does this all mean for you as a viewer, investor, or curious observer? Markets like these are not about short-term headlines. They're about understanding the forces beneath the surface: leverage, liquidity, policy, and real demand. If you take one thing away from today's story, let it be this: price chaos often reveals opportunity, but only if you look beyond the numbers and understand the market's architecture. Stay curious, stay analytical, and most of all, stay disciplined. I'll see you in the next video.